Get ready for the action because Alphabet stock is soaring. It has just climbed to $405.79, briefly touching a fresh 52-week high, bringing the company within roughly 2% of that massive $5 trillion market cap. This incredible surge is all building toward what's expected to be a massive AI showcase at Google I/O 2026, where investors are keenly watching demonstrations of the Gemini 3 model family and deeper AI integration with Android 17. We break down everything you need to know about this explosive move and what it means for the future of tech. Is clearly favoring Alphabet over Amazon, looking at the profitability difference between Alphabet's advertising dominance and Amazon's e-commerce segment. This signals a major shift in investor confidence regarding where the real value in the Magnificent Seven lies. Finally, we face the head-to-head battle. Meta platform stock is down 11% in a month, while Alphabet is up 16%. And the market is clearly rewarding Alphabet for showing tangible AI-driven revenue gains across search, cloud, and ads. We analyze why Meta is being penalized for aggressive spending without clear revenue attribution, and what this means for the future of AI investment. Don't miss out on our full analysis, and sign up to Knockout Stocks today for exclusive stock picks, and get 50% off with the code SPECIAL50. Alphabet Inc. GOOGL stock surged on Monday, climbing 2.27% to $405.79, briefly hitting a 52-week high of $406.29, bringing the company within approximately 2% of a projected $5 trillion market capitalization. This rapid ascent marks a significant milestone, achieving this level in just 87 days from the $4 trillion mark. The primary driver behind the stock's momentum is anticipation surrounding Google I/O 2026, the annual developer conference scheduled for May 19-20 in Mountain View, California. Investors are keenly focused on what is expected to be a major showcase for artificial intelligence, featuring demonstrations of the Gemini 3 model family, deeper integration of AI with Android 17, and the unveiling of AI-powered smart glasses. Market sentiment is buoyed by institutional confidence. Last week, it was disclosed that Greg Abel, who recently assumed the CEO role at Alphabet following Warren Buffett's transition, increased Berkshire Hathaway's Alphabet position by over 200% in his first quarter as CEO. This significant portfolio move is being interpreted as a strong signal of conviction from major institutional investors. Underlying fundamentals remain robust. Alphabet reported Q1 revenue of $110 billion, an increase of 22% year-over-year. Google Cloud proved to be a standout performer, surging 63% to reach $20 billion for the quarter. The division's backlog nearly doubled sequentially to $462 billion, pointing toward sustained future revenue. While Alphabet still trails Amazon Web Services and Microsoft Azure in overall cloud market share, its growth rate is accelerating faster than its competitors, narrowing the gap. Furthermore, the company has mitigated near-term legal risks following a settlement reached with Breathitt County School District in Kentucky concerning a social media addiction case. Analyst commentary remains positive. Bank of America analyst Justin Post reiterated a buy rating on May 17, maintaining a $430 price target, citing Google I/O as a key catalyst for reinforcing confidence in Alphabet's AI roadmap, though he cautioned that substantial AI surprises will be necessary to significantly elevate the valuation multiple. Alphabet's performance on Monday was a clear outperformer, as the S&P 500 saw a marginal gain of 0.13% and the Nasdaq remained flat. Both Alphabet share classes were positioned for record closing highs as of Monday afternoon. Alphabet is unveiling a significant new growth engine that investors should not overlook, according to recent analysis. The company has confirmed that it is directly selling some of its tensor processing units, or TPUs, to select clients, a development that has dramatically accelerated the growth rate of its cloud business. This strategic move positions Alphabet as a prime investment opportunity within the artificial intelligence sector. TPUs, developed in collaboration with Broadcom, are application-specific integrated circuits engineered specifically for AI and machine learning workloads. A key advantage of TPUs is their cost-effectiveness compared to traditional GPUs, making Alphabet's generative AI models among the cheapest to utilize. Previously, access to TPUs was limited to renting through Google Cloud. However, the new sales channel allows companies to purchase and deploy these units directly into their own data centers, a fact Alphabet confirmed during a recent quarterly conference call, noting that TPU sales will be included in Google Cloud revenue. This hardware sales component has had a profound impact on Alphabet's financial performance. In the first quarter, Google Cloud revenue surged by 63% year-over-year, and its operating margin improved significantly, rising from 19% last year to 33% this year. These substantial boosts were major contributors to Alphabet's overall growth, with total revenue increasing by 22% and operating income by 30% in the same period. Analysts suggest that the real financial momentum in the current AI build-out is not solely in the generative models, but is heavily driven by cloud computing and hardware sales. By successfully capturing both of these growth levers, TPU sales and the strength of Google Cloud, Alphabet is demonstrating exceptional performance. Coupled with the financial stability provided by its cash cow Google search business, experts argue that Alphabet is exceptionally well-positioned to fund its AI initiatives, ensuring its continued dominance in the evolving AI landscape. Berkshire Hathaway has signaled a significant shift in its investment strategy under new CEO Greg Abel, favoring Alphabet stock over Amazon. In its latest quarterly filing, Berkshire Hathaway made notable trades, including completely closing its position in Amazon and acquiring over 3.5 million shares of Alphabet, instantly making the Google parent one of the conglomerate's largest holdings. This move contrasts with the long-standing sentiment of former CEO Warren Buffett, who had previously expressed regret over not investing in Amazon sooner. The rationale behind this pivot centers on the comparative profitability of the two tech giants. Both Amazon and Alphabet are key members of the Magnificent Seven, heavily involved in cloud computing and artificial intelligence. While Amazon Web Services, AWS, dominates the cloud infrastructure market, Alphabet's Google Cloud is rapidly growing. However, the analysis highlights a critical difference outside the cloud segment. Amazon's e-commerce juggernaut generates relatively low operating income compared to its cloud division. Conversely, Alphabet's segment encompassing internet advertising, search, and YouTube has demonstrated superior profitability, yielding significantly higher operating income than Google Cloud. This difference in core business profitability makes Alphabet a more appealing investment proposition for Berkshire Hathaway. The portfolio adjustments under Abel have vaulted Alphabet into a top 5 holding. While Alphabet currently represents 7% of Berkshire Hathaway's total investment portfolio, this strategic shift underscores a preference for the advertising-driven revenue streams over e-commerce dominance. Berkshire Hathaway's recent filings also included new positions in retailers Macy's and airline Delta Airlines, alongside closing long-term stakes in companies like MasterCard and Visa. Investors are now watching closely as Able continues to reshape the massive $330 billion portfolio, suggesting further significant changes are imminent. Meta Platforms stock has fallen 11% over the past month, contrasting sharply with Alphabet's 16% rise, highlighting a divergence in market sentiment regarding their respective approaches to artificial intelligence investment. The downturn for Meta is attributed to the company raising its full-year 2026 capital expenditure guidance to $125 to $145 billion, without providing a clear, discrete revenue line directly attributable to AI spending. Conversely, Alphabet experienced a significant rally following its Q1 2026 results, which demonstrated tangible AI-driven revenue gains across its segments. Google Cloud revenue surged by 63% to $20.03 billion, supported by a substantial $460 billion backlog. Additionally, search revenue increased by 19% to $60.4 billion, with CEO Sundar Pichai noting record query volumes. This demonstrated ability to translate AI investment into measurable financial results has rewarded Alphabet. The market appears to be prioritizing demonstrable returns. Alphabet is being rewarded for showing concrete revenue attribution across cloud, search, and ads, whereas Meta Platforms is facing scrutiny for aggressive AI investment lacking a corresponding visible revenue link. While Meta's ad engine remains robust, showing 33% year-over-year revenue growth, the capital expenditure concerns, including an operating loss from Reality Labs, have weighed heavily. Valuation metrics also reflect this divide, with Meta trading at a price-to-earnings ratio of 22x compared to Alphabet's 18x. Prediction markets further underscore the sentiment, with a 95% probability assigned to Meta stock finishing lower compared to a 73% probability for Alphabet to close higher today. The core takeaway is that the market is pricing certainty. Alphabet is being rewarded for showing receipts, while Meta is being penalized for relying on a forward-looking vision. The immediate catalyst for Meta will be demonstrating how its AI spending translates into a discrete revenue line similar to Alphabet's cloud backlog.